How's it going, everybody? Welcome to the channel. Welcome back to the channel. Alright, so a little known company named LYFT is about to IPO. Alright, that means an IPO is an initial public offering. So this is the first time this company will be going public, meaning you, me, and Bob and Sarah can buy this stock. Alright, everyone can buy this stock now. Before it was private, so it's harder to buy stocks when they're private, but now that it's public, everyone can buy it, and it might be a buying frenzy. And recently they just said that its initial IPO is going to be more expensive. So it was supposed to debut around $62 to $68 a share. Now it says it's going to debut possibly around $70 to $72 a share. Pretty expensive. Remember, this is a company that lost over $900 million in 2018. Yes, they are not a profitable company. In case you are wondering, they are not. All right, they are still not profitable and will probably not be profitable for at least the next few years. All right, now I'm just gonna go over some things. I read this really long article. It's a really great article. It's about an hour read though, so I'm just gonna tell you the main points, and I agree with a lot of these points. Now first, LYFT is a ride-sharing company. They have their main competitors Uber right now. Okay, that's kind of a quick synopsis of what Uber is. So basically, you're a driver, you drive for them, you drive your personal vehicle, someone goes on their phone or whatever, their app, goes on Lyft, calls a ride, they go in, they get a drive, like a taxi service. Just instead of a taxi driving them around, it's a regular person, like you, me, and Bob and Sarah, right? Driving them around. And then after that, you know, they pay, and all the payments done on like your phone. And that's pretty much it. The driver gets paid rather than the taxi, and Lyft doesn't really need any drivers. Okay, they can just contract it out pretty much. So that's pretty much what the business is. Now, I'm not a big fan of IPOs just because I don't like when companies sell to me personally. I like to decide when I want to buy the stock. All right, so it's probably going to be a buying frenzy when this thing opens up, but you know, anyways. So I'm just going to go over these key points, then I'm going to give you my take on everything. All right, so this article talks about a few things. One of the cool things it talks about is the Lyft drivers split and how it has increased over the years. So as you can see, in 2016 it was under a 20% split, and then in 2017 it was over a 20% split, and now in 2018 it is higher. Lyft actually takes 27% and leaves the driver with 73%. So because they're losing so much money, they're probably going to need additional revenue streams. This website suggests selling rider data, which is definitely possible. Facebook and Google, it says, have shown that user data has value. Lyft captures millions of data points on rider behavior, location, and travel patterns every minute, and there will be opportunities for the company to sell access to this information. They could sell advertising and entertainment on mobile and in-car screens. That's pretty basic. They could replace underutilized public transit with ride hauling. That's pretty basic. That's pretty basic as well. And a self-driving fleet, so they can get anonymous cars, maybe a Tesla, to drive them around. The next point I want to go over is called the economics of Lyft. How Lyft lost $1.60 per ride in 2018. This is the average fare is $13. The driver takes $9.50 or 73%. Lyft makes $3.50 or 27%. Now, it has all of their operating costs. So their operating costs are actually $5.06 per ride. This goes with $1.07 for insurance, 58 cents for a credit card fee, 22 cents for website fees, 55 cents for its call center, 72 cents for salaries, $1.30 for advertising and promotions, 49 cents for research, and 13 cents for others. So it says with its current cost structure, Lyft actually needs to make 1.6 billion rides just to break even. Given the company handled 600 million rides in 2018 and is growing at 70% per year, we estimate Lyft will break even by late 2021. But only if fixed costs do not increase in coming years. 2021 matches up with the profitability timeline being given out by the management to big bank analysts. Keep in mind that reaching profitability in 2021 assumes corporate costs stay flat going forward, which is an unrealistic assumption. After the LYFT IPO, as the company grows, it will have to staff up call centers, hire new corporate employees, and spend more on advertising and R&D, which is research and development, which will all contribute to rising costs. Without a drastic decrease in corporate costs, currently $3 per ride, Lyft is going to have trouble turning a profit anytime soon. So this is a chart that they then did, which is pretty interesting. It basically says they're not going to break even but before 2026, which is 7 years into the future. And that's in kind of the scenario to faster growing, kind of best case scenario type thing, okay? So these are all the things that they projected. Again, these are all just projections that I want to keep in mind. They're not concrete stats. This is the most interesting I found, and that is Lyft versus Uber. So Lyft versus Uber is definitely the one you want to pay most attention to, just because that's their competition, okay? That's who they're going to compete with, and Uber is IPOing in about the next month. We don't have a confirmed date yet. So Lyft actually has more drivers, with 1.9 million drivers of Lyft and only about 900,000 for Uber, which was pretty shocking because I thought Uber was more popular. Next, this is the yearly customers per driver. So this is where things get a little different. You can see that the average driver on Lyft only gets about 16 customers, while the average driver on Uber gets 102. That's a pretty big difference. Next, this is also a huge difference. This is the annual fares per driver. So the average Lyft driver makes $4,200, while the average Uber driver makes $22,000. Huge difference. So the average Uber driver makes more than 5 times what the average Lyft driver makes. So this is also the Uber and Lyft app US popularity for the last 90 days. As you can see, their charts are like exactly identical. All right, this I found pretty interesting. They're like an exact match. So then it says Uber is the more preferred driving service by far. So it says that 60% of drivers say they mostly drive for Uber compared to only 17% for Lyft. That's obviously a huge difference. It then says that drivers prefer Lyft for its customer service and higher tip rate though. So 76% of Lyft drivers said they are satisfied with their driving experience compared to only 58% for Uber. Another thing I want to stress here is that driver loyalty is actually very low. 80% of drivers have signed up for 2 or more on-demand apps. And it says drivers prefer Lyft for its customer service and higher customer tip rate. 76% of Lyft drivers said they are satisfied with their driving experience compared to only 58% for Uber. So obviously that's a good thing for Lyft. So it says even though Lyft is the most liked, the value of fares determines who a driver works for. 55% of drivers said pay was the most important part of driving for Uber or Lyft. The second most important was flexibility, which both companies provide equally. At the end of the day, a driver is going to go with whichever service offers the highest earnings opportunity, as long as there is not a massive difference in customer service levels. So the next thing I want to talk about is the state of the global ride-hailing market. So this compares Lyft, Uber, Didi, Grab, and Ola. I'll be honest, I never heard of Grab or Ola, but I did hear of the other 3. As you can see here, obviously the number of passengers for Lyft is by far the lowest by a lot. Uber has about 70 million on them. Didi has over 600 million. Grab is about 40 and Ola is about 125. You can also see that Lyft has the lowest number of passengers. They also have a pretty high rate for the annual spending per passenger of $259. Uber's the only one at $500. All the others are rather low. And the annual revenue per passenger is $70, which is pretty good. I mean, Uber's at $113, the others are a lot lower. But the interesting part here is the driver company revenue split. So Lyft takes 27% and the driver gets 73%, where Uber gives you 77% and takes 23%. In my opinion, this is where things look kind of bad for Lyft, because Didi takes 21%, same with Ola, and Grab takes 20%. So Grab is the lowest of all of them. So when you really think about it, why would you want to drive for Lyft when you can go drive for Uber and you would get more percent? Same with Didi, Grab, and Ola. And Lyft is losing money at this high percent, and they've upped it. Hopefully they don't up it anymore. I mean, in a way, because how many people are going to want to drive for them at the end of the day? This might be a big reason why the average Lyft driver only makes just over $4,000, where the average Uber driver makes like over $20,000. Now it says using comparable company price to billings and price to revenues, Lyft should have priced between 15 and 23 billion, placing it at $42 to $65 a share. The Lyft IPO looks like it will debut with a market cap of 23 to 25 billion, which is in line with the valuation of Uber at the whispered IPO size of 120 billion, but far above valuations implied by recent funding rounds of global ride-hailing companies. The Lyft IPO is going to set a new high watermark for ride-sharing company valuations. Now, if you're wondering about share ownership, this is kind of how it breaks down right now. So employees own the most at 48%, and then all the other ones kind of fall in line. Some big companies that own them are, say, like GM, Fidelity, and Alphabet, being Google, are kind of the big ones. It looks like 12% will be public. So this is a pretty interesting too. It says share lockups. Most of the shares owned by insiders are locked up for 180 days from the date of the prospect's filing. Insiders can start to sell their shares on the 181st day after the filings, which falls on September 2nd, 2019. However, if the date the lockup ends falls on a blackout period just prior to earnings, the lockup will end 10 trading days prior to the blackout period. September 2nd is not close to an earnings reporting period, so we expect September 2nd will be the ultimate lockup expiration date. LYFT share lockup expires on September 2nd. Looking at Google, Facebook, and many other stocks, lockup expiration often puts downward pressure on share prices for a week or two. Solid companies with high growth and good fundamentals easily grow through this weakness. But for traders, lockup expiration dates are important milestones to track. According to the prospectus for the LYFT IPO, it has 14 million options outstanding and another 46 million restricted share units, RSU, given to employees. So there's also lots of uncertainty around how long the cash from LYFT's IPO will last. If LYFT goes public at $65 a share in the middle of the offering range, which it looks like it's going to go higher, the LYFT IPO will net the company $2.2 billion after all listing fees are paid. Adding to the current balance of cash and liquid investments and subtracting the taxes due of $404.8 million from the IPO, LYFT will have $3.9 billion to work with. Looking at the cash burn, the company spent $280 million on operations and another $330 million on equipment and buying other companies in 2018 for a total burn of $600 million. If the burn rate continues at this pace, the company would run out of its money in 4 years. However, breaking apart working capital, we see significant positive working capital changes in the last 3 years, which offset a good portion of operating losses in 2018. Positive cash from insurance reserves and accrued liabilities offset $740 million of the $911 million net loss. We think it's unlikely that the company will continue to see the same level of positive working capital change year after year. Looking at operating cash flow without these positive adjustments, LYFT has enough cash for only 3 years of operations at the current cash burn. So it says, as an offset to the operations burn, the company spent $250 million buying another company last year, contributing to a big cash burn from investing. If management takes a break from buying companies, the cash burn from 2018 will be at least 30% lower, giving the company an extra 10 months to operate before the cash is gone. Years of cash is so important because LYFT is up against the clock to turn a profit before their money runs out. In the roadshow presentations, management would not commit to a timeline to turning a profit, so this is the big unknown hanging over the stock. Realistically, with interest rates low and a risk-on mood in the market, LYFT can continue to issue stock and debt to fund operations if needed. The longer losses continue, the higher the risk that the company may be unable to raise money when it needs it most, sparking a fall in the stock price and a hostile takeover by a financial or strategic buyer. So this one I found pretty interesting. This was a price to sales will drive the stock, not cash flow. Our positive opinion on the stock, despite all the uncertainty around profitability, stems from understanding how the market values high growth companies like LYFT. The LYFT IPO is priced off of sales, and in the current risk on market environment, this will remain the preferred metric. So here's a little graph. It says tech company price to sales multiples over time. So it has Amazon, Facebook, Google, and Snap. It has their IPO dates, their price to sales at IPO, their current price to sales, and the annual decline. So you can see here that pretty much all of them have declined except for Amazon. Amazon still sits at a 3. Google went from a 20.4 to a 6.1. Facebook went from a 20.4 to a 6.1. Google went from an 8.5 to a 4.4, and Snap, the craziest one, went from 34.3 to 8.7, and these are declines. So Facebook has a -10, Google a -3, and Snap a -36. So it says, historically, high growth tech companies see their IPO multiple compressed by 10% in a year. As long as LYFT can grow revenues by faster than 10% a year, the company should see a rising stock price. In this market environment, we estimate LYFT will grow at least 20% a year over the next 10 years, pointing to a rising stock price even if the company fails to turn a profit. The theoretical stock price below assumes 22% revenue growth on average over the next 12 years, and a multiple that falls 10% a year from 7.2 in 2019 to 3 times by 2028, where it stays. This is a theoretical stock price, so as you can see here, it IPOs around the $70 range, and in about 11 years, the stock is above 150, doubling your money in just over 10 years. The next thing they talk about is the cost basis of LYFT lockup shares. So these are the insiders who aren't allowed to sell until September 2nd. Now, as you can see here, some people have a very low cost basis. 6 million plus shares were issued at only 23 cents. 8 million plus at 76 cents, and the highest was $47.35 for an average cost basis of $23.55. Now you can see there are a lot of people who own a lot of shares, like at $10 or under. Okay, that is huge. If the stock is even in the same range, that is an absolutely monstrous profit. So here are some ride-hailing facts for you. Ride-hailing costs you $2 a mile, while the cost of driving your car is about 50 cents per mile. The average distance of an Uber or Lyft ride in the US is about 6.5 miles. 1 in 3 Americans used Uber or Lyft in the past year. 900 million people, or 12% of the global population, booked an on-demand ride in 2018. Okay, so that's obviously a very long article. There's tons of stuff. I didn't even talk about probably, a third of the stuff in there. I just talked about the stuff that I found really interesting. At the end of the day, I think I can guess what's gonna happen with this one. Now, I don't got my crystal ball with me. Unfortunately, I forgot it. But my personal guess is when IPOs around the 70 to 72 plus dollar range, this stock is going to go up, okay? That's just how things work on an IPO. Things go up and crazy, all right? It doesn't really matter, I guess. What matters is long term, all right? If you want to buy this stock, I would suggest trading it like they do. I wouldn't suggest owning this stock just because I like the Warren Buffett, Benjamin Graham, even Michael Burry type of investment called margin of safety, all right? So when you buy a stock, you want your margin of safety, you want your moat, whatever you want to call it. And this company would scare me for that point because, one, they're not profitable. Okay, now profitability to me means a lot. I don't like to buy companies unless they are profitable. That's like investing 101 for you. I've never lost money on a company that was profitable. I've only ever lost money on companies that were unprofitable, okay? Literally a quick fact right there. So I don't like to buy unprofitable companies just because I've been burned by them in the past. So if I had to tell you what to do with LYFT, which again, always do your own research, I would say you can buy it, maybe buy options, although the options are going to be expensive for it. But if you do buy the stock, I would say don't hold it for very long and sell out before September 2nd, just because if I'm an investor, an early investor in LYFT, I'm gonna want to take some money off the table, okay? If I invested $100 million, chances are I'm gonna want some of that money back, all right? And if my investment is now worth, say, $1 billion, I'm probably gonna pull off at least half of my investment, just because I want to get my 100 million back, and I want to get my extra 400 million as a profit, and I might leave the other half in there just to simmer a little bit. But again, maybe not. You have to remember that these people, when they buy into a company, this is their ultimate goal. Their ultimate goal. When you are an early investor, your ultimate goal is for that company to take off, go public, have the valuation of the company explode, and you become literally a millionaire, possibly billionaire overnight. All right? Literally, that's how that works. When this company is going to be valued way more than it was on the private market. That's just how things work normally. Now that's going to go public. It's going to be way more expensive. And if you're an early investor, why wouldn't you want to take your money, right? Take your money and run and maybe put it somewhere else in a new company that's about to IPO, or a company that may never IPO, but again, put an investment in there. I'm going to do a video after seeing how it trades and whatnot. My guess, if I have to, this is LYFT. This is the stock graph. This is, say, $100. This is, I don't know, 0. This is, we'll go with 50. And this is the $75 range. So say it's going to start somewhere over here. And we'll go with like day 1, and then we'll go with year 1. Okay? So this is pretty much how it's gonna go. It's gonna start somewhere around here, and on the first day, it's probably gonna go a little something like that. Not quite to 100, but it'll probably end the day, I'd say, at least around $80, all right? It's probably gonna go like this for a little while, and then Uber's gonna come, and there's gonna be some competition, and it'll probably stay around where it IPO'd for maybe the next couple months, all right? Then, when September 2nd finally nears, this is where 2 things are gonna happen. So this is September 2nd. So next thing that's gonna happen, so there's 2 possibilities. Next one is that it's basically gonna start to go like this and probably go something like this. Or it's gonna sell off and it's gonna go way down, and then it'll probably go something like this and possibly return some of those gains, but finishing under its IPO price, all right? So that's your 2 options, depending on how many people decide to sell, all right? If there's gonna be a fizzle out point, the fizzle out point will come either when probably Uber, so this stock may fizzle out when Uber IPOs. It can go down quite a bit after that. I don't think it'll go too low, but I think it will be around its IPO price, maybe a little lower possibly. It's the September 2nd date that I would worry about the most, is because, you know, if the people want to sell out, the stock's going to drop quite a bit, all right? It's just how things work. And again, you have to see what the earnings do and everything. If they turn profitable in the next, well, they're not going to turn profitable in a year, but, you know, you never know, years out, things might change. Again, many variables can happen, but this is kind of what I think will happen to the stock. I have a feeling instead of maybe going down this much, it'll probably maybe go down around here, say like the $50 mark, and then go back to its IPO range in maybe the next year or 6 months to a year, depending. Again, this is all speculation. I don't know if I'm right or wrong. This is just my personal guess. It might be wrong, might be totally off base, who knows. But I guess we're gonna have to wait and see. It's kind of an expensive company right now. I think they're pricing really high. I mean, this is a pretty high market cap. I mean, yeah, they're disrupting the business, and I get what they're doing. Like, I'm not gonna lie. Like, this is obviously a big thing, ride sharing, right? If they can get an autonomous driving down, that could really change their business. But again, Uber's the one they got to worry about, all the other companies too. But it'll be pretty interesting. It's going to definitely be a Lyft versus Uber thing. And I'll do a video maybe in the next few days after this, or in the next week, talking about how the Uber IPO, or how the Lyft IPO went and my thoughts on it. Anyways, hope you enjoyed the video. If you did enjoy the video, remember, always smash that thumbs up button, hit the subscribe button, maybe turn on that bell notification. And until next time, see you later. Have an absolutely amazing, fantastic, beautiful, one-of-a-kind day, and I'll see you next time.